Forms of business entities. Now, in today's presentation, we'll look at the different forms of business entities. A business, of course, exists to make a profit. A business can be carried out through one of the business types we are going to look at. So we have three main types of business entities. We have sole traders, partnerships, and limited companies. Sole traders are those people who work for themselves. Examples can include the hairdressers, the local stationers, a plumber. So a sole trader relates to ownership in that one person owns the business entity. This type of business entity is quite small, and of course there are no formal procedures required to set up a sole trader business. In addition to this, a sole trader can decide how the business is going to be run and is free to dissolve or sell the business at any time. A sole trader has unlimited liability. If the business runs up debts that it is unable to pay, the proprietor will become personally liable for the unpaid debts, and of course would be required, if necessary, to sell his private possessions to repay them. The second form of business entity is partnerships. A partnership occurs when two or more people decide to run a business together. Ownership is divided between at least two people. Usually, these partnerships have no more than 20 individual partners. But of course, like sole traders, partnerships also tend to be small in size. Examples include accountancy practice, legal practice, and we can also look at a medical practice. In general, the partners have what we call unlimited liability, although there may be circumstances when one or more partners have limited liability. Of course, a partnership is normally set up using a deed of partnership, and this usually contains the amount of capital each partner should provide, how profits and losses should be divided, rules on how to take on a new partner, and then how the partnership is brought to an end or how a partner leaves. The third form of business entity is limited liability company. The name limited company is derived from the fact that the owners or the shareholders of a limited company enjoy limited liability. Okay? This means that the owners or the shareholders are only required to finance the business up to a certain point. This point is the shareholders' share capital, i.e., that amount of money each shareholder has invested in the business through purchasing shares. Being that it's a limited liability company, we have to apply the separate entity concept. The business is regarded as being separate from the owner or the owners, and the accounts are prepared for the business itself. The distinguishing factor, of course, that differentiates a limited company from a sole trader and a partnership is that a limited company has to prepare annual statutory accounts. Of course, this is the price to be paid for the benefit of limited liability. Limited companies must produce such accounts annually and may have to appoint an independent person to audit and report on them depending on the size criteria. Of course, a copy of the audited annual accounts must be sent to the Registrar of Companies, which maintains a separate file for every company. In our next presentation, we are going to look at a sole trader, the advantages and disadvantages, a partnership, its advantages and disadvantages, as well as a limited company. We try to go deep on a limited company and then its advantages and disadvantages. Thank you for watching. Thank you for listening. I remain Senior Hannington.